Hello and welcome everybody, and thank you for joining us on today's webinar, the Hotspotting Empirical Formula. I'm delighted to have you all joining us as we dive into the world of real estate and we show you the formula that has selected the top 50 locations in Australia for above average rental yield and outstanding capital growth. My name is Tim Graham and I'm joined by our Hotspotting founder today, Terry Ryder. Terry, how are you?
I'm very well, Tim. Great to be having this conversation with you today. It's actually a real opportunity for us to be having a webinar where we get to talk about ourselves, what we do and why we do it and how we do it. Because normally with these webinars, we're actually hosting other people and highlighting what they do. So it's a great opportunity to explain to people how we go about identifying and highlighting the best places to buy across Australia.
Yeah, and certainly interesting times at the moment as well, with a lot of multi-speed markets all over the country.
Yeah, we're just in the midst of producing the next edition of our price predictor index, which we'll be talking about today. And it's always a process that's incredibly revealing because we look at pretty much every town and suburb in the country and the patterns of growth or decline that we find in each individual market and what's happening with clusters. And we're just now analysing all of that. There's so many different trends that are evident, so many different stories being told, and emphasising yet again that we don't have one market in Australia. We have many different markets all running at their own speed, influenced by what's happening with their local economy, which is very much the foundation of how we make the selections that we do.
Absolutely. So as we mentioned today, we'll be talking about the empirical formula. So we'll be sharing some valuable insights and strategies we've used to deliver these remarkable results, some of which have been in excess of 30% capital growth in the last 12 months. A bit of housekeeping. We'll be talking for roughly 45 minutes today. We're hoping to leave about 15 minutes at the end for Q&A. You are welcome to ask questions throughout the webinar in the Q&A box, but we'll try to get to as many questions as we can towards the end of it. So yeah, thank you again for joining us, and we'll kick things off by starting our presentation for today. Terry, give us a thumbs up when you can see me. We all good? Cooking with gas. All right. So discover the formula that consistently delivers remarkable results with areas experiencing up to 30% capital growth in the last 12 months alone. Today, the agenda is, what is the empirical formula? Let's talk about some of the results of the empirical formula. Then we're going to talk to you about the price predictor index, which is basically a formula that Terry's used since 2006, which really underpins a lot of our research. So this is how we identify rising markets, declining markets, and obviously try to pick up patterns that are happening throughout Australia. So we'll give you a bit of an indication of how we use that, and then how do we combine both of those formulas to create some success in real estate. And towards the end, we'll also show you some bonus content. One is a topic that Terry is very fond of. It is the past does not inform or predict the future. And it's a really interesting subject. So if we stick around to the end for that, you'll also have the opportunity to take advantage of a couple of special offers we've got for you today. Without further ado, Terry, the empirical formula. Do you want to take us through exactly what that formula is?
Yeah, well, it's one of those words, empirical, which each letter of the word means something important. That's a foundation for what we do in identifying good places to invest. Empirical actually means evidence that relies on practical experience rather than on economic theories. And very much what we do and how we select locations that we're happy to recommend as future hotspots is based on a practical experience in those markets. So the E empirical stands for economy, and this is one of the key foundations of our methodology. We will not recommend areas that have got one-horse town economies, places that are fundamentally reliant on just one economic sector. We find volatile and high-risk locations. So we're looking for economies that are strong and diverse, ideally a place that's got 4, 5 or 6 really strong economic sectors pumping, creating economic activity and jobs in the location that we're considering. Market size is important. We don't, there's a lot of media published about median price growth, phenomenal median price growth in some locations, but often it's a falsehood. It's an aberration caused by a very small sales sample. We tend to want to focus on locations that have a minimum of 50 dwelling sales or house sales in the past 12 months, those markets that are dominated by apartments, the same thing. We want to see a certain market size, then we can start to trust the data and to believe that that market has sufficient size and quantum bulk to be a market that's got the ability to go forward long term. Population is important. The size of the population, ideally, we want it to be at least 15,000 people. We tend to prefer larger areas than that, perhaps 50,000 or more, but there are always exceptions. Sometimes we find that smaller places with populations of maybe 15 or 20,000 can be very good performers as long as there's other really strong factors happening in that area. Infrastructure is one of the key things we look for. We always want to invest in areas that have got good existing amenities and services, but in particular areas that have got major new projects happening in the infrastructure space, because experience shows us that very few things create real estate growth than a big program of major infrastructure projects. And we're going to talk about some case studies a little bit later in the presentation that really illustrate that point really strongly. Rental market, obviously low vacancies, and that's not hard to find at the moment, but there are markets around the country that have 3, 4, 5% vacancies, not that many, but low vacancies are likely to put up with pressure on rents is a key factor. It's very rare for a market that's got, say, 0.5% vacancy rate and rents rising at 15 or 20% a year to not have prices also growing. Employment opportunity is very important. That arises out of some of the earlier factors like the infrastructure projects, like the strength of the economy. Where locations where jobs are being created in large numbers, that means there's going to be elevated demand for both rental properties and properties to buy. Strong potential for capital growth within 5 years. We do tend to take a medium to long-term view of the locations that we recommend in our hotspots report. Affordability. Most people out there as investors are looking to buy affordably. There are some investors who are $1 million investors and above, but the vast majority of people who want to buy affordably, and particularly in these times of high interest rates, they're looking for above average rental yields, and that tends to be delivered in those markets which have the lower price ranges. And we do, as we will show as we go through the presentation, those affordable areas, those lower price areas can show absolutely exceptional capital growth as well as delivering above average rental yields. Low risk, very important. We avoid those volatile markets, and if a location ticks all the previous boxes, it's likely to be low risk. We obviously avoid volatile markets like mining towns. We tend to be reticent to recommend areas that are fundamentally tourism markets where the economy is essentially about tourism and very little else. They tend to be also very fickle and volatile markets. So low risk is another important factor. So put all that together, a location that ticks all those boxes is a place that's, well, there's no guarantees in real estate, but as close to a guarantee as you can get to deliver really good, steady, sustainable capital growth over time.
Very good. So, I mean, looking at some of the markets we analysed in the most recent price predictor index, Terry, we've obviously noticed that one of the factors that are really affecting Australia at the moment is the lack of listings. And you can have a great formula that tells you, this is a great area, but the challenge is that some of these markets are so overheated at the moment because there's a lack of listings and such high demand that it makes it very difficult. And it sort of seems like some of these hotspots around Australia are so competitive that it's hard to win a deal in.
That's right. And, it's kind of introduced a new factor we've had to be mindful of putting together some of our reports, particularly the price predictor index, because that's very much based on what's happening with sales volumes. But there are locations where sales activity appears to be below par, but it's because there are so few listings of properties available. Markets like Perth, Adelaide and Brisbane in particular, where there's been a high volume of sales in recent years, and the quantum of properties available for purchase is very low. Demand tends to exceed supply. There's constant complaints anecdotally coming out of those markets from both investors and also professionals at the coalface of these markets, that there's a lack of stock or a lack of quality stock, which means that properties that are available are selling very quickly. But it's also a danger time for investors in that when there is a shortage of properties available for sale, there may be a tendency to grab something that's available. Better than grabbing nothing might be the mentality, but it can be risky to grab a property that doesn't tick all your boxes just because you want something in that growth market and you haven't done thorough due diligence, and you're buying something that's not really of the quality that you would otherwise want.
So let's move on to see some of the results of the empirical formula. So we call it our scorecard. The empirical formula really underpins both of these reports. The one on the left here, sponsored by Washington Brown, is a report that is really, it's probably priced more for the B2B audience. So your buyers agents, mortgage brokers, real estate professionals. So the Pulse report is the top 50 locations, and I'm about to take you through some of the results of that from 12 months ago. So if we were to look back at the Pulse edition from May 2023 to now, and then on the right-hand side, you'll also see the national top 10 positive cash flow reports, a bit more of a consumer report. So maybe an investor is looking for a good spot to invest, but doesn't necessarily need 50 choices to look through. But both of those reports, we use the empirical formula to isolate those locations. So we're going to focus now on the Pulse report from last year. The results of that, so we selected 50 locations with above average rental yields, and the average median price of those suburbs were $381,900. So as Terry just mentioned, we're focusing on that affordability bracket where we do get the stronger rental yields. And typically, in some of these locations, people have probably argued in the past to say that, it's hard to get capital growth in these locations. But as you're about to see, that certainly isn't the case. And you can have your cake and eat it too, both rental yield and capital growth. So our selection 12 months ago had properties or suburbs ranging from 5% rental yield as a gross average through to 8.1. 41 out of 50 of those suburbs, so 82%, more than doubled the national average in 12 months. So across the 50 suburbs, the average capital growth over a 12-month period was 18.48%. And PropTrack currently says that the national dwelling average to April 2024 in 12 months was 6.6%. So as you can see, in real terms, it's probably closer to triple the national average. The average uplift on those properties, if we were to apply it to the median price, was $72,000, and then the average uplift in rent across those 50 suburbs was a further 12%. So not only are we seeing capital growth, we're starting with a strong rental yield, but that rental yield continues to grow as well. So it's showing, Terry, both demand in the resale and also in the rentability.
Yeah, I think the key point to make about that is we select these top 50 locations across Australia. The first parameter is their rental yield. So we're recommending places that have above average rental yields because we know that a lot of investors are looking for that in these times of higher interest rates. But we also want these to be locations that have the potential for capital growth, emphasising the point that you don't have to make a choice between high capital growth and a high rental yield. You can have both if you select your location well. And this report proves the point. They're all places that have above average rental yields. They're all places where we've seen really big uplift in rents, but at the same time, there's been this fantastic capital growth in the vast majority of them as well. So it's emphasises the point that select your location well, follow the advice and reports like the Pulse, and you can have that win-win-win situation, a low buying price, above average rental yield, and excellent capital growth.
Very good. So if we move along, we've got 5 case studies for you today. So this is from the report from 12 months ago. Terry, we'll start with Orelia in Western Australia. So as you can see there, we saw 28.4% capital growth in the last 12 months. Median price even today is still only $470,000. So certainly still very much an affordable market. The rent in Orelia has grown 16.3% in the last 12 months. Do you want to talk to us a little bit about that market and how the empirical formula applied to this market?
Yeah, look, it's an interesting one, this one, because it's a great example that what you might call ugly real estate actually does grow in value extremely well if it ticks all the boxes for the empirical formula. This is the bottom end of the Perth market. Just a couple of years ago, median prices were below 300,000 in suburbs like Orelia. This is the local government area of Kwinana, down in the south of the Greater Perth area. It is the cheapest sector anywhere in the Greater Perth market. It attracts both buyers and renters for that reason. But it's got a lot of other things going for it. It's got good basic infrastructure, shopping, schools, etc. Very importantly, it's on the train line linking to central Perth. But perhaps the biggest factor and the reason why we most like this market, apart from its affordability, is right next to a very, very big employment zone. There's a big commercial and industrial precinct not far from this suburb where there's tens of thousands of jobs. People who live in areas like Orelia are highly likely to be working in that precinct, where some of the biggest names in the Australian resources sector, for example, have major facilities. So lots of reasons why people would want to live and rent and buy in a location like Orelia. And if they'd been buyers 12 months ago, they would have been delighted with the capital growth they've got.
And looking at days on market there, Terry, only 16 days median time on market at the moment, and the rental yield's grown to 6%.
That's right. You know, perhaps you would say the norm in normal markets that aren't quite as hot as Perth has been recently, days on market might be 30 to 40 days. Probably sell within a month, then you're pretty happy as a vendor. But in places like Orelia, it's much, much faster than that at the moment.
Interestingly, when analysing the days on market nationally, out of the top 50 suburbs, I'm pretty sure 40 of them were all in Western Australia. So that market's still certainly very hot from a buying perspective, but we've also seen that we think we're probably nearing the top of a lot of the markets in Western Australia as well.
That's right. Perth has had 3 years of very strong capital growth, and there's evidence in various data that we look at that perhaps the Perth market has reached a peak, and it's a danger time for investors piling in there and buying without too much care and consideration. You've got to be very careful right now in the Perth market what you buy, where you buy it, and how much you pay for it.
That's right. It's good advice. Okay, moving on to withers in Western Australia as well. So again, 25.9% capital growth there. Rental yields now got up to 7.6%. And we're looking at 16.3% rental growth in the last 12 months.
Yeah. So this is part of the city of Bunbury. Bunbury is the largest regional city in Western Australia. Very important city. It's an export port of significance. It's got good links to the capital city, Perth, but it's a very strong regional city in its own right. It's underpinned by a number of factors, strong links to the resources sector, but also there's manufacturing and tourism and other factors feeding its economy. Withers is perhaps the bottom end of that market, one of the cheapest suburbs, and a lot of people have bought there for that reason. And they were able to buy a couple of years ago, perhaps in the 200,000 or 300,000s. Prices have grown a lot since then, but it's another example that you can buy at the bottom end of the market, the cheapest suburb, provided it's got good solid credentials, a proximity to important things, then you're going to get good capital growth. And that's certainly been the case with Withers in the city of Bunbury in the southern part of Western Australia.
Okay, moving on. Last one for Western Australia is Gosnells. So 24.4%. Rental yields now at 5.9%, and we have 12-month rental growth above 20% again, so 21.4%. So across, anyone who says you can't get your capital growth and a high rental yield would be amazed by those figures.
Yeah, Gosnells is another one of those precincts at the cheaper end of the Perth market, a little bit more expensive than the one we talked about earlier, but still very affordable. There's a local government area and a suburb with the name Gosnells. It's just good basic bricks and mortar solid real estate, suburbs that have everything that people need: schools, public transport, train links to central Perth, proximity to major jobs nodes. There's good proximity to the Perth airport, for example. And like airports in all our major capital cities, that's not just an airport, it's a major commercial industrial precinct where there are a lot of jobs. So Gosnell ticks all those boxes, and that's why it's been able to get on board with the Perth boom and deliver exceptional growth in both prices and rentals.
Okay, moving on to Queensland now. So the suburb of Oakey near Toowoomba, 17.4% growth in the last 12 months. Current rental yield of 4.9, and in the last 12 months, we've seen 12.1% capital growth. This is an interesting one, Terry. We talk about the ripple effect, sort of just outside of some of these major markets.
Well, that's right. Another great example of fantastic growth with ugly real estate. Oakey's quite a strange little town, but it's part of the city of Toowoomba. Toowoomba's one of the regional locations that we have been suggesting to people over the last couple of years, and it's performed very well. Oakey's a town in its own right, maybe 10 or 15 minutes outside of the Toowoomba metro area, but it's part of the same LGA. It's got a number of things in its favour. It's much more affordable than Toowoomba, which has become a more expensive market with growth in the past couple of years. Despite having risen 17% in the last 12 months, it's still got a median price below 400,000. It's also an area where there's quite considerable resources activity. It does have an important RAF facility, Air Force facility there as well. So there's a number of reasons why people might live there in terms of where they go to work. I imagine quite a number of the people who live in Oakey would work somewhere in the city of Toowoomba, which is just down the road. But again, affordable, and it's delivered both great rental yields and great capital growth in the last 12 months.
Now, this is an interesting one. You've talked in the past, Terry, about real estate snobbery and not buying in areas that maybe don't fit the mold for a lot of people that would drive through an area and say, look, there's not really an area that I love to live. Elizabeth Vale has been probably tarred with that brush in the past. 19.3% capital growth if you bought there 12 months ago, if you don't mind, and also rental growth of 11.4% again.
Yeah, now there are actually 8 suburbs in the northern suburbs of Adelaide with Elizabeth somewhere in the name, and this is one of them. And it's probably the most down market part of the greater Adelaide market, and a place where many investors might have feared to tread. But those that had the wisdom and foresight to buy in a place like Elizabeth Vale a year or two ago have had excellent results. And just another example that down market real estate, if it ticks all the basic boxes, can deliver. Look, these suburbs, first and foremost, are affordable, but they're also close to really major job nodes. There's a huge number of jobs up in the north of Adelaide. They've got the big Edinburgh defence facility. There used to be a major car manufacturing plant, and when that closed down a few years ago, there were dire forecasts about the damage it would do to the economy and real estate markets, but it's been completely repurposed with other commercial industrial purposes. There's really big industrial precincts up there where there are a lot of jobs, and so people can buy and rent affordably up there. There's the basic infrastructure with good transport links, both train and road, shopping, schools, and proximity to where people are likely to be working. So again, ticks all those boxes in the empirical formula: jobs being created, strong diverse economy, affordability, good infrastructure. The road links and the rail links are undergoing constant improvement, so there's that infrastructure spend happening. Massive amounts of money being spent on the Edinburgh defence base, billions of dollars over time. So that infrastructure spend is happening as well, with ongoing creation of new jobs. So yeah, it ticks all the boxes, and it has performed.
So we've sort of just touched on this a bit, but what do the 5 locations really have in common?
Well, they're all what you might call ugly real estate. They're all down market. Some of them are places where they might have a higher content of social security families, for example. They may have perhaps higher crime rates. But it's an object lesson for everybody. Then don't be afraid to buy in cheaper areas if they have got good basic parameters. If they tick all the boxes in the empirical formula, they will perform on capital growth and rental growth. Don't allow real estate snobbery, that attitude, well, I wouldn't want to live there. Well, a lot of people do want to live there because it's affordable, it's got schools, it's got shops, it's got everything that people need, and affordability, particularly in times of high inflation, high interest rates, and a high cost of everything, really. Affordability of rentals or purchase prices is such a big factor for so many families. So there's demand in these places that we might ourselves not want to live in. As long as there's demand from lots of people over there for all the right reasons, then you're going to get the sort of growth that you want as an investor.
Now, I've asked you this question before, but we often get asked at Hotspotting why we don't include crime rates in any of our location reports. What's your answer to that?
I just don't think it's terribly relevant. I think it's an overrated factor. As I've just said, there's plenty of places with above average crime rates that have been fantastic performers on capital growth. Look, the key concern for an investor is that you're going to get a good tenant. The fact that you're buying a property in a down market area doesn't mean you're going to get a bad tenant. These places we're talking about all have vacancy rates of 1% or lower. And in those circumstances, if you buy a property and make it available for rental, you're likely to get 15 or 20 parties applying to rent it. And a good property manager, and it's really important to have a good property manager on your team, will go through the applications and pick the best tenant, the ones with the best references, the best track record of paying their rent and looking after properties. And there's no reason why you can't get an excellent tenant buying in some of these down market locations in the current circumstances.
Yeah, absolutely. I think it may not be a popular opinion, but it's certainly one that it's opened my eyes over the last couple of years to look at the stats in some of these locations and realize, as much as we might, look at crime rates if we're going to move into an area to live, as an investment, there's a reason that we can make money in these markets. It's because there's so much underpinning things outside of, crime and things like that that are positives.
Yeah, this media will always highlight the worst in the rental market. They'll highlight the worst landlords, and it will kind of suggest that these are typical landlords, which of course they're not. And they'll highlight the disastrous tenants who cause damage and leave a place in an appalling condition, and represent that as the way tenants behave. But 99% of tenants don't behave like that. Those are the extremes. And if you've got, I emphasize again the importance of having a really good property manager on your team, someone who will do their job properly, sift through the application, pick the best tenant from those who have applied. And in the current circumstances, you should get lots of applications in these areas that we're talking about.
Yep. Okay, so the next part we're going to talk about is the price predictor index. So we don't do a lot of, it's featured in the media quite regularly, but we don't do a lot of public talks about this but we really should, because it does underpin most of our research. So, we can go and look at the empirical formula and identify locations that have got all the, hallmarks of growth in the future. But if we just use that and we didn't use an indication of where a property is in its cycle, then you could quite easily fall into the trap of buying at the peak of the market. So it's important that when we look at the empirical formula that we also use something like the price predictor index, which is a proprietary formula to Hotspotting, where we track sales volumes. Where most real estate economists are constantly talking about median prices, rising and falling. It's not really the best indicator for what to expect next. So, and that's because median house price statistics are prone to significant anomalies, which can lead to inaccurate analysis of a location. Median prices also focus on what has already happened, whereas investors are more interested in what's going to happen. Instead of median house price data, we focus on sales volumes. Based on the trends in the data, the price predictor index is a forward-looking tool to identify locations in growth or decline, helping you decide where you should invest next. It's based on a simple premise that the number of sales comes first and the prices then react later. So by using the index, investors can buy ahead of price growth, finding locations where sales have grown, but prices have not yet moved. This report tracks state-by-state locations where sales activity is rising and therefore prices are likely to rise. And at the other side of that, sales activity is falling and therefore prices are likely to fall. Sales activity is being steady and therefore growth can be steady as well. So Terry, this particular autumn edition, which will be released next week, analysing the data there, you said that there's a couple of trends that you've noticed on this occasion that just haven't been there in the past in relation to listing volumes that are affecting markets.
Well, that's right. I found over more than 10 years I've been doing this report quarterly, that is a great forward indicator what will happen on prices, because there's a time lag between when the market changes in terms of the number of sales happening and when that starts to show up in prices. So, but lately in some parts of Australia, we've had this additional factor, which is perhaps creating a misleading impression. And that is locations where sales activity has fallen, giving the impression that the market is weakening. But one of the key factors why that's happening is because there's so few properties available for sale. Now, it's not happening everywhere in Australia, but there are parts of Australia, key cities, both capital cities and regional markets, where there's been a dramatic drop in the number of properties that are available for sale. And that's been at least partly responsible for the reduction in sales volumes in those specific locations. Now, examples are some of the strongest markets in the country in the past 12 months or so, Perth, Adelaide, and Brisbane in particular, but also some of the regional markets. And a case in point would be Townsville in North Queensland, where there was a significant drop in sales volumes in the March quarter compared to the previous quarter. But all the evidence suggests it's primarily because there's just so little property for sale, because what's previously been for sale has been snapped up by home buyers and investors.
And that brings us to talk about the past doesn't predict the future. So hotspotting focuses on the potential for property investment locations based on expected changes in the local economy rather than past performance. What does that mean? If you were to look at a location that hasn't performed well in the past, that doesn't mean it won't perform well in the future. Success stories like the Sunshine Coast and Perth demonstrate how areas with low capital growth rates can experience significant growth due to infrastructure development and economic shifts. Investors should not overlook locations with strong future growth potential despite poor past performance. I mean, a great case in point of that right now would be Melbourne, Terry. We've seen really, really slow sales volumes over the last 12 months, or probably 2 years now. But this is where you look to buy in a market like this, at the lull in the market.
Well, that's right. And unfortunately, far too many investors and potential investors are herd animals, and they'll base their buying decisions, both when they act and where they buy, on media headlines. They hear there's a boom on, they want to pile and be part of that market. Smart money would have bought in those places 2-3 years prior. So we recently actually ran a webinar which said why Melbourne makes more sense than Perth right now. Lots of people want to buy in Perth. 3 years ago, when we first were recommending Perth, people weren't interested because its previous track record had been so poor. Now everybody wants to buy there when the market is, based on all the evidence we have, at a peak. And that's not the smart time to be getting into that market. Whereas Melbourne hasn't performed on price for the past 2 years, but all the indicators are the next few years are going to be much better. And now's the time to be focusing on a market like that.
So here's some examples of how the price predictor index and how ignoring the past has really worked in our favor. So we use the empirical formula in the price predictor index, and then we ignore the lackluster past performance to identify the Sunshine Coast and the Perth markets as strong opportunities well before any other economists in the country. Similarly, we've identified that markets that were cooling off, such as Sydney, well before interest rate rises occurred. So if we look at this report here in 2019, this is when hotspotting started talking about the Sunshine Coast market. We look back here, the median price there was 642,000 back then. Today it sits just over that $1 million mark. But as you can see, very lackluster performance prior to that. But if you were to only base your decisions based on its history, then you could have missed out on all of this uplift. Probably worth noting, Terry, we also picked the decline over here as well, and we've also picked that we expect it to start to ramp back up in the Sunshine Coast now.
Yeah, that's right. The Sunshine Coast right now is actually going through that inevitable correction phase where prices are flatlining or falling off a bit. That always happens after a market's had, say, 3 years of really strong growth, and on the Sunshine Coast it was. But what you're looking at on screen right now is a great object lesson for so many things. Firstly, the past does not inform the future. When we wrote that report about 5 years ago, and people were saying, why would you recommend the Sunshine Coast? Its track record for the last 10 years has been hopeless. But the reason why we're so bullish about the Sunshine Coast, we knew it was changing, and it was fundamentally the big infrastructure spend. A few places in Australia had the kind of investment in new infrastructure that was happening on the Sunshine Coast at that time and continues to happen. It was more than $20 billion with the new hospital precinct, upgrades to road links, upgrading the airport to international status, and a whole lot more. And it just created so many jobs, brought new people to the Sunshine Coast to live and work, and many of them highly paid medical professionals working in the $5 billion medical precinct, and that certainly pumped up the top end of the Sunshine Coast market. So at the time we recommended, people weren't interested. Later, when they read there was a boom on, they wanted to pile in. The smart money does their research, reads reports like the one we wrote 5 years ago, and understands that something major is about to change in a market like the Sunshine Coast at that time. Opportune time to buy then, and those that did would have done extremely well. Currently going through that correction phase, but the evidence is it's about to have its next surge of growth. So now might be the opportune time again to be reconsidering the Sunshine Coast market, although it's a lot more expensive than it was 4 or 5 years ago.
That's right. Much like Perth. So if we look on the right-hand side here with this magnifying glass, this was the national top 10 best buys report by Hotspotting back in December 2020, where Rockingham City first made its appearance in the best buys. If we go back and have a look at where that market sat in Rockingham, WA back then, we're looking at a median price of 390,000, lackluster growth leading up to that point, median price 563,000 today, and in the last 12 months alone, 17.3%. Another case in point, I mean, I think there was probably a handful of people in the east coast of Australia back in 2019 who would have dared buy in the West.
Well, that's right. The performance of the Perth market prior to 2020 for the 10 years had been pretty poor. In fact, prices around that time, 2020, were lower than they were 10 years prior to that point. And so when we started recommending places like Rockingham City, there was major pushback saying, well, why would you recommend this market? It doesn't perform. And particularly Rockingham City, because it was at the lower end of the Perth market. These were down market suburbs, even though many of them were bayside suburbs. And we could see things were about to change in the Perth market. And these very affordable suburbs with great transport links, proximity to major employment nodes, and the ability to buy close to the ocean for those sorts of prices back then was an opportunity not to be missed. But back then, not many people were taking our advice, and sort of 3 or 4 years later, everybody wants to buy there, but after the 3 years of big growth. So it's a lesson to people to get into the market at the right time, to not be herd animals, to do your own research, to be well informed, and understand when markets are about to change, and to buy before prices rise highly.
Yeah. Okay. So the highlights of this autumn edition, Terry, did you want to take us through the findings of the price predict index for the one we're about to release?
Yeah, certainly. The first is that it reinforces that we don't have one market in this country. Lots of different scenarios playing out in the country. The markets that are rising strongly, some that are rising moderately, some flatlining, and some that are falling, both in capital cities and in regional markets. We do see further evidence that the Perth market has reached a peak, and we urge caution, people thinking of piling into that market. If you're going to buy in Perth, be very careful about what you buy, where you buy, and how much you pay. We've seen the evidence of a comeback on some of the markets that haven't performed very well in the last few years. We've obviously seen very great price performance from Perth, from Adelaide, from Brisbane, but cities like Canberra, Hobart, and Darwin have been underperforming. They haven't had anywhere near that level of growth in the last 12 months. They've had no price growth at all, basically. In some cases, prices have fallen a little bit. Now's the time to be considering markets like that, because the evidence is that sales activity is picking up there. Some of the economies are strengthening that had been weak. Darwin, for example, we're starting to see better population growth coming into the Northern Territory. So it's an opportune time to be considering markets that have underperformed in recent years, but are about to show perhaps better growth. The shortage of listing, yes, it's a factor that we haven't had to think about too much in the past while basing our formulas on sales volumes, because there are some markets, as I said earlier, where the reason why sales activity has dropped is because there's just so few properties for sale, a major shortage of homes listed for sale. So not necessarily a downturn. And in the report, we do highlight those instances because it's not uniform across the country. There are many places in Australia where there's no shortage of listings at all. Gladstone, perhaps rather surprisingly, has been one of the star performers of this edition, certainly in regional Queensland. The Gold Coast market has moderated. It's been one of the stars of regional Australian markets for the last couple of years, but it's moderated based on this evidence. But Gladstone is really outperforming. There's a big uplift in demand there, and not surprisingly, given that the major investment that's going into that important central Queensland regional city. Elsewhere, one of the stars is actually the Wollongong Illawarra type precinct, particularly Shoalhaven, just outside of Wollongong. Wollongong is strong. Shoalhaven, the suburbs and towns in that local government area near Wollongong, very, very strong. Lots of rising markets at the moment. There are others around the country. We're starting to see another one of the trends is that locations that were boom markets in what is known as the COVID boom back 2020, 2021, and have since subsided, had that correction phase like we saw on the Sunshine Coast, and now starting to show signs of coming into the beginnings of their next growth phase. Places like Albury-Wodonga at the border of New South Wales and Victoria, Ballarat in regional Victoria is another example. We see evidence that the Sunshine Coast is starting to emerge from that correction phase. Other examples around the country, they're all highlighted in this upcoming edition of the Price Predictor Index, which we'll be publishing next week.
Very good. That brings us up to a couple of limited time offers that we've got. So if you like what you've heard today about the empirical formula and the Price Predictor Index, we've got a couple of deals, 25% off for the national top 10 positive cash flow hotspots. Simply use the coupon code PCDISC, which we'll put into an email with the recording that comes out later today. But the PC disc here will give you the discounted code for the positive cash flow report. And for any of the real estate agents, mortgage brokers, financial planners, etc., that might want the top 50 locations, the Pulse report comes as a 50-page PDF, but you also get the spreadsheet of all the data as well. So you can manipulate that document anyway, which way you please. So we've got a 25% discount on that as well. The coupon code TP25 is available for that. And you can find both of those reports on our website at hotspotting.com.au/reports. So take advantage of that one. We're about to head to questions, but before we do that, for anybody who's not a member with us already, all of the data and the insights that you've seen there, you can see on our Hotspotting members portal with the Research Hub. That QR code will allow anybody who's signing up for our basic level of membership, which gets you access to the portal for $299 a year. You'll get a free credit of $250 to go towards a report of your choice. So if you wanted to grab a Hotspotters membership, you can get that top 10 positive cash flow report for free. And then also, again, one for the B2B. So any buyers agents, mortgage brokers, etc., that might be interested in a premium membership, which gets you access to all of our 120 LGAs. We typically have that for $2,499 a year. But if you sign up before the end of this month, you also get a free Pulse report, which is valued at $900. So, Terry, we'll head to some questions now. Before we do that, is there anything else you wanted to add in relation to the PPI?
Look, just reinforcing that it's really I know that the word unique is overused in real estate, particularly marketing individual properties. They're all unique according to the marketing agents, but this report is unique. No one else does a report like this where we look at the entire country. Every significant town and suburb in the country is examined in terms of the trends with its sales activity, and we give them all a rating, whether they're rising, recovering, consistent, declining, or plateauing. So, and that gives a forward indication of what might happen in prices in those markets. And in the front of that very comprehensive report is all the analysis, all the national trends that are evident. We have a top 50 supercharged suburbs list. We have a top 50 consistent suburbs list, because consistency of sales activity is a very important factor. These are safe places to buy. We also highlight the worst 50, the ones that are declining at the moment, the ones you might want to avoid at the moment. And we have the top 10 municipalities around the country, clusters of suburbs that have growth factors. So much analysis and information in that one report. Great opportunity to be extremely well informed. It's a report that tends to take perhaps a short-term view. It's giving people clues of what will happen in the short term with prices, whereas our hotspots reports tend to take a long-term view. You combine those two factors, a place that's got the credentials for short-term growth and also the credentials for long-term growth, then you've got the ideal investment location.
Very good. One of the first questions from Sally is that in the empirical formula said that you stick to each one of those metrics, but every now and again, if something, I think what they're saying is if we don't meet something, but all the other factors are quite strong, we'd still put it in there. There's a good example of that recently with Moree, Terry. It didn't meet the population factor, but we still included it in the report. Do you want to elaborate on that?
Yeah, a location like that, we can see something significant changing, even though based on the population numbers, it doesn't tick that box, but it ticks a lot of other boxes. There's a lot of major government investment impacting on that in strategically located regional town, including the Inland Rail Link, which is the biggest infrastructure project happening nationally in Australia, $31 billion. The part that impacts Moree is currently being built. It's on the route. It's one of the key hubs along the route linking Melbourne to Brisbane via inland New South Wales. Also state government investment going there. So we put all the other factors together, and so this is an example of when we might depart from one of the parameters in the empirical formula because the others are so strong. It's a location of very affordable and fantastic rental yields. And so another example might be Dalby in Queensland, west of Toowoomba, a smallest regional city, but with a strong, diverse, growing economy. Lots of things happening out in that territory, and it's been a fantastic performance the last 12 months, both on rental growth and price growth.
We've got one here from Amy Rogers. Amy saying, "Hi Terry and Tim, do you take into consideration the ratio of owners to renters when assessing areas, and what impact does that have on your decision?"
Look, it's not a huge part of our decision making. I know some people do think this is a strong factor. I think it's another one of those ones that might tend to be a little bit overrated. Sometimes I think people overanalyze and they suffer from paralysis by analysis. If it doesn't tick those sorts of strange formulas, then they won't buy there. But I think some people prefer to buy markets that have that nice balance for, say, 2/3 owners and 1/3 renters. Some markets have a high percentage of renters, and that's deemed by some people to be a negative. I don't know that there is. I don't think there's any evidence that places with, say, 40% renters or 45% renters has inferior capital growth. So it's not a huge factor to consider.
No, I just think the demographic of a renter has changed so much now. I mean, I can tell you, some of the markets now, even estates that are refusing to allow investors into their estates, and they say we don't want tenants in here. I just think that's ludicrous. I'm a tenant. I'm a rent investor, and there's plenty of them. People are choosing to live that way now, and I don't think I put as much weight on the ownership percentage as I used to, because the demographics of the people renting these days have changed significantly. So I'd be looking at all of the other factors around transport, distance to local jobs, and what's coming to the area before I'd be looking at the demographics on home ownership.
And a great example of that is, excuse me, locations that have hospitals and university campuses in their midst. Those two big pieces of infrastructure tend to cluster together. You can think of like North Melbourne, Carlton area of Melbourne, also the Monash area, Monash City. Fantastic performers, real estate over time. Both places where there's big hospitals, complexes, big university campuses, much higher than average component of renters because they're close to those big facilities. And that higher ratio of renters doesn't stop those areas from performing very well.
Yeah, I'd agree. We've got a question from Chris, just wondering whether these cash flow and growth principles can also apply to blocks of units.
Look, absolutely. And increasingly, we have been charting high demand from buyers for units. We're seeing capital growth performance much stronger for units. We're actually seeing more examples of suburbs around the country where apartments are, in terms of median prices growth, are outperforming houses in the same location.
Not just in 12 months, but also over a 10-year average as well now.
That's right, long term as well as short term. There's a growing number of buying cohorts demanding apartments for not just affordability reasons, but also lifetime, also safety and security reasons. And you can enhance that factor by buying perhaps a small block of units. And because one of the things you get if you buy well with a small block of units in a good location is an elevated rental yield, much better than buying an individual unit. You have control over the whole complex. There's potential to perhaps add value for renovation at time, but if it's in a good location, it's going to give you capital growth as well. So it can be a very good investment. Of course, it requires deeper pockets than buying an individual apartment somewhere.
Question from Amy, where is Melbourne on the property clock?
I think it's at the beginning of an upcycle, and that's why we're thinking it's a really good time to consider Melbourne as a place to invest. We know that Melbourne is a great city, that it's had a great track record over time. The population data in particular is hugely strong for Melbourne. More of the recent high numbers in population growth are found in Melbourne than anywhere else in Australia. The underlying economy is strong. It's now, by some measures, the biggest city in the country, very important economically, and it hasn't shown much price growth in the last couple of years. It's overdue. So we would put it at the bottom of the cycle, about to go into that beginnings of the up stage of the cycle. So there's plenty of upside, I think, buying in Melbourne.
Yeah.
You've just got to perhaps overlook the behaviour of the state government, which is a bit of a turn-off.
That's it. Well, I was going to say, look, I think the biggest turnaway here is our state government, stamp duty, land tax and things. But look, at the end of the day, if you're buying well, it's just it's something you've got to factor in. It's a pay-to-play model. I just wouldn't have too many properties here. But it certainly deserves a spot in your portfolio at the moment. Question from Jules. What are your thoughts around Brisbane and any hot areas to keep an eye on?
Yeah, long-term Brisbane, a great future. Its population growth is elevated. People are have traditionally moved to Brisbane and Queensland for lifestyle and climate reasons. So that's still happening. It's still relatively affordable compared to the two biggest cities and to Canberra. It's got a very big infrastructure program going on at the moment. And it's going to get bigger because the host, or the primary host for the 2032 Olympics, and if they can get their act together and stop mucking around, sorry, the administration of it so far has been a bit of a worry. But Brisbane will be hosting this big global event, and they have to upgrade their transport infrastructure, their hospitality infrastructure, their sporting infrastructure. And it's going to be big investment and a lot of jobs, and a lot of people come in to live and work in Brisbane, as well as the Sunshine Coast and Gold Coast, because they get a big chunk of the action as well. The Sunshine Coast, incidentally, another factor in its favour, reason why it might be a good time to buy there is the latest federal budget has committed at last money to build the rail link to the coast that has been desperately needed for a long time. They have to have it if we're going to have the Olympics or play the Olympics there. So, yeah, Brisbane's prospects look pretty good. It's one of those places where the sales volumes have fallen off in the March quarter, but we do believe that a big factor there is the big shortage of listing. If you look at a chart showing the listings of properties for sale in the greater Brisbane area, it's just dropped dramatically in the last couple of years.
Yeah. One thing I would say on the Brisbane market is you can make a decision that you want to go and invest in Brisbane. And it's all well and good to say that, but then in theory, to actually go and secure a property within a fair price range, is not as simple as it once was. I think we used to just say, oh, I'm going to buy a property in Brisbane, and you just go ahead and do it. But with the lack of listings and how competitive that market is at the moment, it's not quite as simple as just saying, I'm going to go and buy it. And there's less off markets, all that type of thing. So you really got to have a pretty strategic plan, and maybe a nice local buyer's agent or something can help you there, because it's a tough market.
Yeah, and I was also having a conversation with somebody who's a real estate professional, lives in Townsville. So when he, as soon as he heard that about the Olympics and everything that's happening around that, he bought an affordable unit in one of the near city suburbs of Brisbane, and I think that's, generally speaking, not a bad strategy. As I said earlier, we're seeing elevated demand and better price performance for apartments. And well-located apartment in the Brisbane market gives you an affordable entry to a market that's showing growth. You just got to choose your location well. And I would suggest not buying in a generic, high-rise where there's 200 or 300 apartments all the same. Something more boutique with a bit of individual character might be better. Yeah.
We've still got a mountain of questions here, Terry. I might have to join a couple of them together. We're asking a lot of questions, obviously, about different locations around Australia. I've got questions about Melbourne's West, Point Cook, Tarneit, Wyndham Vale, Bateman's Bay, Ipswich. There's a lot in that. So did you want to give any commentary on a few of those?
So the name of the locations again, Bateman's Bay was one of them I heard.
Yeah, and then in the west, so Point Cook, Tarneit, Wyndham Vale. The question in particular was about the fact that there's a lot of supply of land out there as well. So how that sort of plays into your decision making.
Look, I think that's another one of those factors that people worry a little bit too much about. We wouldn't buy an area where there's land for future development. Look, it's not a great concern, certainly at the moment, because the building industry doesn't have the capacity to build a lot of houses. The federal government would like Australia to build lots and lots, 1.2 million new homes in the next 5 years. It's not going to happen because the building industry just doesn't have the capacity, and the costs are so elevated, and the shortages of everything, including tradespeople. Those areas which have land for future development, it's not really a factor right now. But even in better times, the development industry does tend to develop according to market demand. It's kind of rare to see these areas become massively oversupplied with new dwellings, because the owners of that land develop them according to demand. And so there have been instances where there's been oversupply, but it's a long time since we've seen any dramatic cases of that. So I wouldn't be too concerned about that as a factor. Mentioned Bateman's Bay, that sort of south coast, New South Wales, south of Wollongong. That's one of those precincts that's doing really well at the moment. I mentioned Wollongong and Shoalhaven, and heading further south to the places like Bateman's Bay, the Eurobodalla local government area. There's really good, strong buyer demand in these places for lifestyle reasons. Don't necessarily recommend buying in some of those places because they're essentially tourism retirement markets, but right now they're pumping pretty strongly.
Yeah. All right. we've hit the 2 o'clock mark, so I'll give you one more question while I share our offers one more time before we wrap things up. The last one was in relation to Geraldton. Some more info on that market, Terry. I know you're a bit of a fan of Geraldton.
Yeah, Geraldton's one of those places that we have featured in our reports recently and continue to do so. It's an important regional city of Western Australia, the biggest regional centre north of Perth. It's got an important export port. There is major state government investment going into Geraldton. It's very affordable, great rental yields, and it hasn't really been, some of those Western Australian markets like Mandurah and to a lesser extent perhaps Bunbury have been inundated with investor buyers and become very competitive. I think it's a little bit easier to buy sensibly with due diligence in Geraldton. So it's definitely a place worth considering, I think.
Very good. Well, that's about all the time we have for today. There are still a mountain of questions in there. We will try to get back to you on email to a couple of those questions that are a bit more pointy. But thank you, everybody, for joining us. We look forward to seeing you again next time. Take care.